chance that if this crashes, tell me.
I know, I told something at you.
Maybe I
Last
should
time it
get up.
crashed,
Cause Steve's
I tried to
watching
get
it.
attention.
Yeah.
Steve.
Yeah, Steve was.
And I was trying to get her attention, and every then she said, make sure. If I'm gonna be fighting this kind of heat. I said, okay.
Okie dokie.
My responsibility.
We are on it.
Oh, and wash off. I'm sorry, nope, all right. We're still, thinking a couple more show up, but we're not gonna wait too much, we're not gonna wait any longer, just hopefully they'll show up when they can. Call this meeting to order, City Council Quarterly Financial Review Session on, excuse me, Thursday, July 30th, 2026 at 6:13 PM. We have one item on the agenda, it's finance, second quarter 2026 financial review. So I will turn it over to Mr. Marsh.
So what I want to do is first let you know that it's commonly misreferred to as a budget study session. It is not a budget study session. We're not studying any one particular department's budget. You do have the ability, though, to challenge anything or ask some for more exploratory response to some of the line items if you so choose. But I'm going to give you the overall state of the city financial presentation so that there are things that you need to be aware of, things that you probably would be of interest to you as far as the finances of the city as a whole. The first thing in your tablets or in your packet is I presented to you the consolidated actual to budget line item revenue and expense. It does look similar to this report. And this report, well, that's weird how that starts like that and just moves. This report shows all the revenue line items within the city, and it shows the dollar amounts that have been collected by those line items against the budget as a whole for the city, and where we are as a city for each of those individual line items. Now, a lot of those line items presented are unique to a specific department, similar to the animal registration is for animal services. The accident reports are obviously police. So you know they are pertinent to a specific department's ledgers. But there are some of the revenue streams that you look at in here that are unique. For instance, this rental income senior center, there's no budget for it because that just was a revenue source that started as the senior center became rentable for events after the senior center was used for its stated initial purpose. You have other revenues that have not yet to come in. You have some revenues that are just projected still. There is an insurance settlement item that came in. Usually when that's the case, you will see a line item for the expense that is offsetting, and that will be down in the expense lines. So you can go through each one of these, and if you have any questions on them, one of the things I do want to point out is franchise tax. Anytime you look over on the far right of this report during the revenue side and see a number below 50%, that means we're ahead of budget on that item. That means the revenues are ahead of where we anticipated them to be for the first 6 months. So one of the items is franchise taxes. Right now it's 49. It's just slightly ahead, meaning the franchise taxes collected so far in the first 6 months are ahead of what we anticipated them to be. Overall, we budgeted $560,000. The city sales and use tax, you're seeing both of those, city and county, are ahead of schedule. They're 48% left to collect of what we budgeted. So that's how you would look at that. The A&P is the same way, the A&P tax receipts. I will point out that there is a new line item that we are doing. I will get more into this in the detail that I will be presenting in the PowerPoint. But the A&P tax discount is something that we are tracking now on the A&P side. This will be of interest to you, Roger, because I believe you're now going to be on the A&P commission. So the A&P tax discount we're offering if they pay within the first 20 days of the tax collection period for the previous month. If they do, they take the 2%, and we're doing that as a contra revenue account to show you how much money would have been paid if we didn't have the discount, but we have to honor the ordinance that we have, which says that if they pay early, they have the option of taking a 2% holdback. And we're going to show you how much that money was. We're also showing in a line item the penalties for not paying on time. So there will be an A&P penalty. Whenever they pay the penalty, that penalty is being isolated as a revenue line. So penalty started in July, so we don't have any in June. I'll go down and we do the same thing for the expenses. This is the city's expense lines as a whole. The reverse is true. In this case, in the expense side, if this number is greater than 50%, that means you're ahead of you're doing good as far as the budget is concerned. It's opposite of what the revenue would be. So in the fuels, we anticipate that by now you would be 50%, half of what we budgeted in the first 6 months. Well, right now we have 60% or 60.5% more to spend in that budgeted account. So the fuel vehicles, while it impacts some departments more radically than others, one that's more car labor intensive would be the police department, who's not here. He's very concerned about that budget. He's doing steps to try to mitigate the cost as well as the fuel for equipment to other departments. They're looking at making sure they realize that cost of fuel is high, and they're doing things to mitigate the need or the spend. So I do want to point out that when you see this is the city as a whole. For your benefit, Rod, when you just came in, you have this in your book. This is the entire city's spend for each of the line items for revenue and expenditures. So you can see where we are as far as that's concerned. And I do on the bottom of this, taxes was interesting, this 3,105 versus the 2,900. The 99% of that is taxes for the fire department's building out there. Now, we under budgeted that because the taxes came in higher than anticipated. And so we did pay those. As far as the insurances is concerned, I have just received the renewals, and I will get into that as far as what that's going to be. The reason you don't see anything there, except for the 769, that's an insurance on some addition to the water department's building that we just started to insure. So that's for the period for the policy, which lapses, which will be renewed in August. I do have the renewal, and I'll get into what those are. As far as the maintenance on the senior center, that's a line item. I'll get into, there's a positive note on that, and I'll show it to you when I show you actuals in a 5-year comparison. The playground equipment, very close. The ones in orangish color are kind of a little bit of a yield, kind of a yellow light versus a red, meaning we're over budget in those areas. But just wanted to give that to you. Capital improvements, this is the biggest item. We have in a total city 11 million for capital improvement projects, 271,000 for capital expenditures. So in that area, we have an $8 million left to spend on the capital improvement projects. So if you were to look at the city as a whole, taking out all transfers in and out are merely a shifting of expense that's reimbursable from one department back to another. The offset to that is in the revenue. That's been removed from this just to get down to what is the actual revenues and the actual line item expenditures. We have a surplus so far for the first 6 months of our revenues are our revenues are $343,000 more than the $8.4 million that we have spent so far in 6 months. We are budgeted to be a deficit of $5.1 million, largely due to the capital improvement projects, largely due to the water sewer department, and I'll get into that as well. So this is favorable. This is very good, as far as where you're sitting, where the city's sitting in 6 months financially. Now, if you have any specific individual questions later, you can give me a call, send me a text. I'll give you the detail of what makes that up. I'll forward it to you. Or you can ask if you review these between now and Monday. I'll be more than happy to get back and present that answer at the Monday's city council meeting. So I just wanted you to know that was in there. And now we go into what's the results for the first 6 months. So what I want to start with is how the funds are, what the funds are doing by each of these departments. And all you need to know is that this is cash is king for us. We are modified cash-based accounting system. So we don't book revenue when it's accrued. We don't accrue it. We book it when we actually receive the cash. So these bank accounts, there are 8 of them within the city, 8 physical bank accounts. We have a number of bank accounts that are only established on our accounting records that are sub-accounts of actual accounts. They are in green. Anything with a V, they're called virtual accounts. So this is how we look at, and these are restricted funds. These are how we look at how to account for monies that were earmarked for a council-approved spend or a state-approved spend, a state-required spend, or something that had to do with a restriction due to some kind of a grant, or parks, where they want to isolate monies for a specific project, such as the splash pad and the inclusive park. The Michael LeJean Lakes Trail sign, money was collected for that, and it hasn't been spent. It's still sitting there because there hasn't been a decision on what they're going to be doing with the money that was collected from donations. But those donations were for that specific purpose. So that's why we've isolated those. It's the first column that is the 6-month revenue from what we've collected in those accounts. The 6-month expenses in the third column over. The 6-month deficit or surplus for each of those departments for just these 2 together, take the revenue less the expenditures. This column compares to, you need to look at what the 2026 budget is. That's for the whole year. So when you looked at, for instance, the CSUT fire, right now they're sitting at $44,741 surplus this year, and that gives them a new balance of $1,000,003. That is exactly what's on our books as of 6/30 in the actual checking account, identified as a virtual. The amount that we budgeted them to have is a surplus of 30 for the total year. So they're sitting very well right now. They're positioned to meet that and or exceed that surplus. Parks has a $149,000 deficit right now. They're supposed to end up with a deficit in CSUT of $43,000. That's the money that was used from the city sales and use tax specifically for parks purposes. The reason the $149,000 is a deficit right now is because they've made the transfers that were budgeted for the the Parks Inclusive Park Fund of the $150,000 that comes out of there, as well as 2 capital expenditure items from CSUT that were also diverted to the inclusive park. So that's why there's such a big drain right now there. Now there's going to be a catch-up of that for the next 6 months because those big ticket items have already been sent over to the other virtual account. So while that looks ominous right now, there's 6 months of revenue that's going to help offset that. I think I did a cash flow for them, a projected cash flow to present to the Parks Commission. And it looks like if everything goes the way we kind of anticipate our projections of revenues and our projections of the expenses for rolled forward for the next 6 months, they might be at about 50,000 instead of the 43. They might be a little short. They might, but it's the money that's earmarked for parks. It's not devastating to them. They probably will come in at or just slightly below 200,000 in their account to roll forward. Still sitting in a very good, favorable position. We are managing that, so they hear it every month. DTF Control Fund still has 21,000. We don't budget a surplus or a deficit because the thought is that whatever comes in from the DTF Control Fund is like grant money, and they use the money in the police department, and so what comes in is used or it's carried over to be used for the purposes that the DTF Control Fund requires them to use the money for. You can see every department. One of the ones in here for the Lopvy Police, they were sitting at a beginning of the year with 63,000, part of our contingency fund thing that we decided to do in order to establish the contingency fund and to get the budget that we had approved into a more reasonable position. is that we decided to, rather than hit the police and fire department up with what their LOPFI retirement expense was gonna be based on salaries, is that we would help offset that by reducing the 63,000 in that holdback, if you will, down to about 28.5 by pulling out another 34,000 to offset the need or the expenditures for 2026 on the police and fire side. So yes, that it looks bad right here, but unfortunately that deficit is caused by the fact that the state aid that comes in to help offset the LOPFI kicks in July through November or October-ish. And so we have little to no LOPFI contribution because of that offset. And it won't start picking up again until November and December. So this number, it looks bad in June, but I'm not worried about it. This 615 negative is in a virtual account. We've already covered it in the month of July. So those sit really pretty. Advertising and promotion, they have a deficit of 7,900 in their spend. They're sitting at 35,000. They're looking to have a budget number of 43,000 because we're saying every year when we do a budget for A&P, whatever they get in, they usually like to grant out. So that's why we don't ever budget them with a surplus or deficit. We let the chips fall where they may, or the dollars fall where they may, and they are, whenever we give a financial report to the A&P Commission, they know how much money they have to spend, as you too well know. Let's go to the street department. The street department has 3 virtual accounts in it, but there is really only one street account. It's called the street operations account, street O&M. Street does have an operations department. They do have monies that come in for revenues. The revenues and expenditures, right now, we brought in $922,000 for 6 months in the street, all accounts, all in. We do isolate turnback funds now. As you know, from the beginning of the year, we've pulled that into a separate virtual account so we can account for all the revenues that come in and all the spend from that. Same for city sales and use tax, the tax dollars that come in and the tax spend. And the sidewalk department, we get monies from permits, for instance. There has been no outlay of money from the sidewalk department. Right now, the sidewalk department is sitting with, the sidewalk fund is sitting with $254,000 in it as of June 30th. There's $350,000 in the O&M because they have already overspent, or have a deficit spend of $242, but that's not a bad situation because the approved budget is for them to spend down $495,000. So they will end the year right at about just under $100,000. That's what the approved budget says. As far as the approved budget is for the street city sales and use tax, $488,000 should be their spend down. That'll give them about $500,000 left in there to roll over. The $748 will be after a $71,000 spend down of their turnback funds. Those projects are in the budget and earmarked. So they're not doing too bad. The only thing that we have to watch is this O&M because that's their salaries and their normal operating supplies that don't meet the criteria for any of the turnback or street. Their vehicle and their maintenance on the vehicles, their fuel for the vehicles, all of that. We're going to have to look at whether this is sufficient on the budgets for O&M for next year for street. I'd be, given their run rate, that's probably not going to be enough with the revenue stream that they have. We'll have to see how that cash flows. But that's my crystal ball through now on those. Let's look at the sewer and the water departments. This is the sewer fund. They have one account called Total Sewer Operations. Sewer O&M revenues were $1,000,004. The sewer collection and sewer plants spent $1 million, a little over $1 million. So there is a $482,000 surplus. Right now, their ending balance is $1,000,005. And I'm going to show you the historical on the sewer department where they were losing, they were in a loss situation for several years, and they were being held up or propped up by the water revenues that had come in, and we were cash managing them. One of the biggest reasons that there was this rate increase that affected sewer was the fact that there was a lot of need to cover the sewer deficits due to our bond covenant that we weren't meeting. One of the things that I wanted to point out, though, is that while they have a $500,000 here in the surplus for the first 6 months, and Water Department has a little bit of a budgeted surplus, their numbers are very healthy. And I'm going to show you why that's a little bit misleading because of what we did when we did the cash flow analysis that went into the rate increases. A lot of people don't understand why and how that happened, but I'm just going to hold this up. This is the cash flow statement that I did with the Meg from Hawkins and Weir to be able to show that the rates would cash flow, the debt service, the funded depreciation, the reserves or for contingency. All of that was built into this cash flow statement, and that's how that rate was based. You guys were given that presentation and you approved that on the onset when that rate increase went into effect in '24, and we decided to split the rates between the variable and the fixed portion of the rate. 1 year was one and the other year was now the full impact, and we gave them a year off on the fixed cost. I will let you know, though, that the water sewer consolidated operations is very healthy. Right now they have a surplus of $1.1 million and a budgeted amount that they're supposed to end up with about $500,000. They're going to exceed that. I just want you to know that. The city sales and use tax, though, this is a different story. This is where the monies are earmarked for the capital expenditures, and that's significant because the capital monies that are being brought in are not sufficient enough to cover what they presented as a 5-year capital plan of what they, meaning Greg and Tim, put together the list of what projects they had on the books currently and that were already funded and what was yet to have to happen in the next 5 years and what that estimated cost was. And there was about a $7 to $8 million shortfall in that. So that's the shortfall even with the $2 million that they're getting in revenue for each of the years going forward for 5 years. So just to show you, this year alone, they budgeted to have $6,488,000 as a deficit spend, even with their capital spend that they had budgeted. So water sewer was looking at somewhere in the neighborhood of about an $8 million deficit. You had almost $6 million in the bank. And at the time that we did this, so we were looking at a significant amount of financing that was going to have to be done. And I think we were looking at about $7 million over maybe 20 to 30 year bond. Now the bond would be collateralized by the water rates, by the water systems revenue, meaning the people that have utilized the service, the rates that they are being charged and they pays the bond debt service off first. So what you're looking at here is they would be needing at the end of the year, if they did every project that they budgeted this year, they're looking at $3 million shortfall that we would have to be looking at doing some kind of funding or financing on. Well, I'll show you a little bit more about that as I go through the water sewer side, and I'll give you some more detail on that. But right now, I don't think financing this year is necessary because of where their spend is and where their projected spend will be for the remaining 6 months. So there's going to be a lot of items that are either going to be scrapped, not done, change of plans, and or pushed off. As far as the general fund is concerned, this is the one that generated the contingency fund look. The general fund started the year with just under $1 million in the fund. They have generated $2.2 million in revenues and $2,198,000 in expense, so they're up $46,000 for a surplus in the first 6 months. That brings their fund balance to $1,004,000, and $189,000 is what we budgeted as a deficit. And that says that that would bring our fund balance to $764,000. That's where that is above what the contingency was, the contingency fund you set. I will point out that the revenues and the expenditures come from these 6 departments. And each one of these 6 departments has an operating budget that has no cash unto themselves. It goes into the general fund as unrestricted. So these were the surplus generating departments. Planning has generated right now, 7,552 deficit for the first 6 months, but they are making strides to make that up. There was some movement in the month of July that's not reflected there. They're still shooting for a $23,947 surplus if all goes the way as it's planned. Police department is way under where their deficit would be right now. For the first 6 months, they're only showing 173,000 in their dollar amount versus the 670,000 that they were budgeted to have. And I don't know of any large major things other than their normal operations that would make us even believe that they would go anywhere close to this amount or go over that amount as their deficit for the year. Realize that police does not have any city sales and use tax to offset their capital spends. We do sort of earmark franchise taxes for that because the franchise taxes are included up in here in the unrestricted monies. I guess the bottom line for as far as the general fund is concerned is the general and admin department has generated right now for the first 6 months $119,000 in surplus, and that's well on their way to their 342. So everything looks good. All indicators are go. For the remaining 6 months, a hiccup would have to happen. It can, but right now it's looking positive. The city consolidated, just for what you see, there's one account that's not listed here. It's payroll. The payroll fund is an actual fund at the bank, and the reason it's not up there is it's normally it's called a funded account. We don't keep money in there other than the amounts that are there to clear checks. We fund that account with every department for the payroll, and if we don't, trust me, we get a call immediately. You plan on writing a check to cover this money? So we put the money in the bank to cover the payroll that we do. It's usually immaterial amount residual in the account. So it's included in this other cash fund down here, along with CDs, along with other funds that we have that is quickly convertible to cash. So when you look at the total city as a whole, we have a budget to reduce the total all-in funds by $7.2 million and bring us down to an all-in city fund of $6 million. We're sitting right now at 6 months at $11 million, only down $500,000. And mostly that's due to capital projects that are being done. Any questions on the funds? Okay, so what I'm going to show you is the same thing again. I don't know why I have 2 of those in there, but I do. Okay, so this is the contingency calculation, and this does go through the June 30th date. You saw that in your July. I do want to point out that the contingency fund is $71,000 over the ceiling of $932,000, and you realize that the floor is $746,000. So we don't, if it goes below 671, which is a 10% reduction from the 746, automatic triggers happen in order to try to bring that back up, and then the control shifts to you guys in order to make what steps necessary to bring it back up to at least the floor. But right now we're sitting 71,000 over the ceiling, which was established by your 15% target for the contingency fund. This money, if today were December 31st, would be put into a virtual restricted account for contingencies. That is how every year you're building that contingency fund. You then could say at some point you've got enough in there to meet your needs, and you could do away with contributing to it and just use the monies in your normal operating budget. But 1 year is not a trend to count on, and I really think that we're going to be looking at a couple years more in order to build that to any kind of a substantial balance again. I'd like to get it built to about $1 million and leave it there. But this will help us in our bond ratings. It helps us in our financing structures for any kind of a loan. They always want to know, what are you doing for your rainy day fund or your contingency fund? And the fact that we have these trigger points and we have a policy that resides in now ordinance fashion that says, this is what you have edicted for the city to ensure that we don't go below what would be necessary for us to continue operations in a crisis. All right, so here's what I wanted to show you regarding the water sewer. This is a little historical. You probably can't read these numbers. That's why I have the graph there. But I do want to show that this is from 2011 all the way to 2022 when we started the process of the 605, the state law that says that we had to do a rate review and we had to make a rate change. So one of the things that I'm going to show right here is the water sewer cash basis of accounting. These are audited numbers now. These are not my unaudited. These are the live reported numbers. I want to point out that the top number is the water, and you see they're all very healthy, except for the year 2022 when their net income was only $84,000. And then you'll see in the sewer department started in 2018, the first year that I had official reins here. They were in the red, and they continued in the red, gaining momentum, if you will, of how much their loss was. And it got to the point where the water department could not cover the loss of the sewer department enough to be able to meet the bond covenant. So one of the things we did is we decided that we wanted to pay off the bond for the sewer department, which would help the covenant situation, and we couldn't because there was a restriction placed on that bond, if you recall, that said we could not pay it off early. So what we did is we did a technical defeasance, and doing so, we took the money and reserved it, restricted it, to hold it there as a placeholder to pay off the bond, so they could not say, well, the reason that you have this covenant is in case you default, and then you would have that money aside that we would be able to go get. Well, by our technical defeasance, isolating that money, we were able to not have any issues with the bond, and it kind of headed off at the pass. But this right here is where the big reason why it's a good thing we did the 605 mandated us to do the rate increases for all municipalities in the state, because our operating expense line exceeded our revenues. And that happened in 2022. In 2023, we did the rate study, and the rest is history. But there hadn't been an increase in the sewer department side since 2011. So that's a long time for people not to have any rate increases in water sewer. And you're starting to see it catch up right here. And this is every year, that historical trend. The only reason this is a blip is because that was COVID year, where we stopped all projects and stopped unnecessary spends because we didn't know what was going to happen to the revenue stream. So don't think this was put together haphazardly. This rate was well thought out. So what I wanted to show you is a little bit about what is misleading about those numbers that are sitting in the O&M, saying, well, look, you're sitting on $1 million right now just in the first 6 months. Well, there's things that are accounted for in that rate that are not isolated off yet. And I will show you the gross revenues. This was the 2023 year where we first determined what the next 5 years rates were going to be. And this is after the implementation of the rate increase, what the rates were anticipated to go to. So the revenues over the expense for operations led us to $1.4 million, but we still had a loan because we anticipated some sort of financing necessary in order to be able to go after those projects that were 5-year projects and get them done. 80 to 85% of those projects were all infrastructure of current, it's maintenance and repair of current infrastructure in the ground. They weren't growth oriented. They weren't adding lines in order to spur on future growth. So that's where you would be more likely to go after bond financing, or some kind of financing would be in that kind of a project because you can recover that over time with the new commercial developments or the new residential developments, and the tax bases that would come in would help increase the revenue streams on the permanent 1% city sales and use tax for water sewer. Anything you're doing to pipes in the ground doesn't really gain you a real quick turnaround or recovery period. And I do understand that, but sometimes you have to go to the well in order to finance projects due to not really thinking ahead back several years ago. As far as the loan is concerned, the debt service was factored into this, and the rate finance capital costs are $167,800 all the way up to $183,500 in the 5th year. Those are factored into then say what would the net income be when you take the debt service, the loan debt that comes out of your operating monies, and the amount of the financing costs that are built into the rate. And you'll see that it brings your $1,000,004 down to a total net income of $465,000. Well, one of the things we also didn't factor in were the reserves. So some of the things that we built into the rate was the annual contribution, which is the contingency monies. So 86,000 and 87 and 89 and 88,007 and 9,000, they were all factored in to come to at least $250,000 worth of contingency fund for them. It's a little less concerning to us in the fact that they have a permanent, they're unique, they have a permanent 1% city sales and use tax for capital. So they're not having to rely on their operations for the capital as much as some other municipality that doesn't have that. The refurbishment and replacement reserve for the annual contribution, that's funded depreciation. So the first thing you saw in the first year was we accounted for to fund the year that we don't have. In other words, it's a catch-up of the assets that are already fully depreciated. There's going to be some need to go purchase them, and so we were reserving a dollar amount, and therefore every year after that, for whatever assets you buy, we initially start funding that depreciation so that we can turn around and use that money to buy the asset rather than having to hope we have enough left over to buy whatever tractor or whatever they need.
Tom, real quick. On that O&M reserve annual contribution, is that supposed to be 87,000 and 90,000?
No, I think what we did is we looked at a cap on that for about 250 or whatever, I don't know, $1,000. You will look at that every year. If you think that dollar amount, which should equate to 2 months of their operating expense, we just got there quicker we're just building it. Because right now they don't have it. They are using their O&M as their reserve. We want to tuck that away as their reserve so they don't use it and it's there in case they need it. So it's not a build to forever, ever. And what do you have in there now? Well, we have more in there than we have in our tax account. It's like $7 million in there. That's not how that works. You do get to a point, like when you do a HUD loan does a replacement reserve. If you don't say anything, they will let that go as, you pay $40,000 a month to them on a major $1 million project. You'll keep doing that until you go approach them and say, what's your minimum residual in there? And then they'll tell you a number, and as long as you're over that, they will allow you to amend the agreement, your loan, and stop it until such time as you fall below their reserve requirement. So we don't do that. We'll build it to a requirement. The next thing you don't see in here is the CPI, the inflation rate. We allowed the governing body and the commission to recommend and actually ask for a CPI increase every year if they wanted to. And we do discuss that I do discuss it with the commission. At the end of the year, we talk about should they be looking at raising a rate for this coverage of the rate inflation. Right now, because you have no debt that you're still collecting through the rate structure, there's no real need to go after any inflationary rate right now. So that's why they're holding the line. And they can consider that next year in or the year after, I think, is when we have to look at the next 5-year rate, because it's every 5 years they have to do the rate study. And that doesn't mean they have to raise the rates when they do the rate study. So just keep that in mind. One of the things down at the very bottom you see here is if you were looking at what the net income would be after, you're looking at, it's more reasonable. It's refurbishment and replacement reserve balance year end, again, is about $125,000 to $210 catch up all the way through. That's your funded depreciation amount that we're booking. I did an operating ratio right here down at the bottom. Doing that, it's the operating revenues over the operating expenses and financing costs, anything you have an outlay of cash on. The total operating cost of $3.2 million versus your operating revenues. Remember, this number, usually a lot of people like to see it being high, but as a percentage on operating ratios, optimum efficient operating ratio would be in standard practice 85% or lower, but not to be below, let's say, 50%, because the lower you go, the more hoarding you are, and you're not spending your money wisely or having it reinvest. And so but anything over 85%, you're inefficient. You're closing the gap between your operating costs and your operating revenue. So these numbers that we planned were in the 74, 75 range. So we're right optimum. Optimum, they say, is 70, but we're right there. So that's why the rates came out the way they did, because of everything that you don't see in this long sheet of what we projected the budgeted expenditures and budgeted revenues to be in this form. So I just wanted to give you that. At every city commissioner meeting for, you know, more than any of them here, the Water Commission gets these statistics. I don't know if they've ever done that before, but 2018 all the way to 2026, since I started, this is the actual amount of gallons of water sold by month for each of the periods 2018 to 2026. The dotted line you see below that is the trend line of your water sales. It's virtually flat. So I went down, I go down at the bottom and I show each January, each February's numbers, this is what generates your revenue. That's the product that they sell in order to meet the water department's O&M operation cost. Remember, the capital comes from your CSUT. So when you look down here, I gave an 8-year average. The 8-year average is in blue. And then I give them the 2026 actual, and I compare the 2026 actual to 2025 sales, and then I also compare the 2026 actual to the average for the first 6 months of the year. We're 8.4% below average, 17 versus 19, and we're 3.5% below last year's sales. Now, I expect that July will be a lot of sales, I'm hoping, but your biggest month seems to be in the August period, excuse me. July and August are rather healthy sales, usually during hot months where there's no rain. A lot of people will water their lawns and fill pools and do things like that, and they'll generate revenue. We are, however, when you look at where we stand in 2026, you see a lot of red down here on the bottom about where we are below 2025. There's only 1 month that we actually exceeded our sales in 2025. We're 2.51% below the actual 8-year average in sale of water. They see this every single month. I even give them the water accounts growth, annual growth. This is since 2018. This looks very impressive. This is net growth, by the way, because it's ins and outs. It's the net of who leaves and who comes in, establishing new services at residential properties. It's also a good indicator or a fairly good indicator of what your census will be looking at and how it's tracking, because if you take these as households, if you look at the number, that's really only 300 new customers since 2018. that looks like a huge gap because of, I could have made it look flat. But I wanted to give you the show that 300, that equates to, actually have the number somewhere. It equates to 37.5 new, new accounts per month, per year rather, and or 94, right at 94 residents. So if you're, I think it's 37 new, divide that by 8, 300. And then you take it by 2.5 people per household. And that gives you a rough estimate of what your census growth would be. So, then, and again, that's not stellar growth, but it's growth. And same with the sewer account. So if you have the growth, why is that happening when your sale of water is actually down? So it could be a lot of things. Could be, like I said, rain. It could be a lot of rain, snow, and wet, and people aren't using the water the way you would normally sell the water for. And the other would be energy efficient or water conserving efficient appliances that people are buying nowadays. They don't use as much or consume as much water. So,
Just being in clothes washing machines from the last 10 years.
absolutely.
Has
So-
that been replacing old ones?
So here they also get the current customer shutoffs. Now, these are system-generated cutoffs. It's not the actual, because the day before they can go, the day of cutoff, they produce the report and they send the work orders out. But if somebody pays before the work order goes out, they don't necessarily have them go run out there, shut it off, and then run back out there and shut it on. They just tell them, okay, don't actually shut that one off. They came in today and paid, and they have an actual number of shutoffs that they do. But this shows you the trend of shutoffs. They get that. They see what that trend is. And then they also get the new thing that they did. They decided that starting with May of 2025, they now, instead of trying to chase down the accounts and writing off a lot of money, they turned it over to a collection agency to try to collect. And this is showing them the statistical history of how many accounts did you turn over by year and how much recovery did you have on what you turned over. And so the blue number down here on the bottom is the cumulative total. So through June, actually through June, 189 accounts have been turned over, $33,000 worth. And here are the categories of what was in those bills that were turned over. And one of the things that strikes them, commission's ire, if you will, is this category here called sanitation, because you realize that that's on our bill. And if they don't pay it, we still paid for that sanitation 2 cards, and they're eating that. And that's not part of the agreement. And so they've got a bone to pick with how are they getting that recovered. Now, they do have an admin fee, and they do get recovery for some of the accounts, but there's, I think, at least a 30% amount that goes back to the collection agency on what they collect. Now, remember, the collection agency does not bill us for their services. They bill us only for what they recover. So we've recovered amount of $2,964.43. So all in all, since the inception of this, just under 9% of what we turned over, we recovered. I don't know if that's a good thing. If not, it's 9% we wouldn't have gotten anyway. And remember, these accounts that are being turned over are already a year old. So that a year from when they left and the services were cut off. So these are not accounts that currently have service and we just want to turn them over because they didn't pay last month. That's not what this is. These are accounts that have stopped, we have shut them off, and these are people that did not pay their final bill or had a balance due and they skipped.
And we're waiting a year before we go back? How long before we collect?
I think it's a year. It might be less, but the bottom line is there is a little bit of an agreement. If they come back and try to get service back on, that sits in our system and they have to pay that in order to get it back on. And there's also an agreement that we have with other cities where if they go and try to get water service at, Fort Smith, if it's on our books, and there's a reciprocal agreement with other communities other cities that say, you have a bill outstanding in Greenwood, you settle that, and we'll set up your service. You can't go to a local city because they know you still have a water issue that's unsettled.
How long have we been doing that?
Doing what?
The reciprocal agreement?
That, I've only heard about that for the last few years. I don't know how long that's been in existence. It's spotty.
I was in the water office, so I've been out of the water office for 7 years now,
So it's been 7 years?
at
Yep.
least. I mean, they had me doing it like when we were slow, like I would have to reach out to other cities and try to see if, such and such turned on water there. And then they would actually, like, they would go and hang a tag and they would shut them off.
I think it's more electronic now in communications, so where they know, there's a data pool of that. But that's statistics that they get. That's a service, they see it. This is their,
I mean, it's almost 9% more than we were used to getting, because usually we're just.
writing it off, right. And they can collect that as aggressive as they want to be. That number could go skyrocketing. I mean, as you see, we turned over, we get 200. The biggest, we had a big month last month, 668. But, I mean, 12 accounts were turned over. You see the percentages, most of the write-offs deal with the water and sewer side, but the 18.34% for sanitation is just nonsense. That should be bore by the sanitation department. All we are is the billing arm. We're, I guess in that contract it says, and you bear all losses.
So we're the ones making the agreement, and they're the ones bearing the cost loss.
By there, you meaning the water office,
Right.
right? We're bearing the water department, yeah.
Or it should fall back on cars.
You would think.
Fall back on cars.
Yeah.
So if it comes back, I think we have a 3-year agreement, so the contract's not up for renewal for another year or so. But when it is, we need to be having a look at that agreement and make sure there's some stipulation in there to recover this. Because they have no business risk.
Maybe we can use the same company and turn them over to them.
Says Rod Powell. All right, the water sewer fund, they get a fund report and they see what their dollar amounts are doing, and I do cash manage them, especially this is a restricted actual fund. It is a checking account. You cannot operate that account in the red. They will bounce so many checks, it's not even funny. So their change in their fund went from, they had 3.4 million, they're down to 1.3 million in June. But I will tell you, good news. The good news is, this is as of right now, their actual fund balance is 2.7, because most of the reason they depleted it so fast was they had a lot of utilities to move for the road, and we bore the cost to do it, but it was the part that RDOT was to reimburse us for came to $1.6 million. We got the check.
Oh,
Matter of fact, came in Monday. And it's been deposited, and that's why you see only a $677,000 reduction in their fund. I will show you that the amount of capital improvement projects that they have done so far this year from January to June is $2,676,000. That's even with the capital expenditures. And you look at 30%, where I'm going to get excited is by watching this, if I believe that they will get to or reach 70% completion by the end of the year. That's my financial decision point. 70% we're looking at getting a loan, or supplementing it from what's already in the O&M back to city sales and use tax to cover some of their projects, because that's where it ultimately will be paid out from. So we do watch it. City sales and use tax, this is your first look. You'll see this again Monday night, so here you go. 5.26% was our actual cumulative growth. for the month. That's what we're down, not for the month, but through the first 7 months. So while that looks like, well, we're going in the wrong direction, no, that's typical for what we see as far as the biggest period of pickup comes in the first 3 months, and then we start seeing it drop off. But what I look at to see if we're still maintaining our turnaround is these numbers here. The last year to this year, we flipped it. So we're keeping path or keeping pace with where we were in the previous year as far as flipping the script. And if that had been anywhere near what the previous month would have been, we would have been at about 5%. We're still looking at a growth, a little bit of a growth. So budgeting 5.26% is good in the city sales side. The county sales tax, we're 3.64%. We're way above flipping the script. We flipped the script and then some. A lot of that has to do with the fact that a lot of good things happened in 2 cities specifically because we share and share alike in the distribution on per capita. And that was that Bass Pro Shop opened up, and there's a discussion about that by Fort Smith as far as their numbers going up. And as their numbers go up, our county distributions will go up too. And then there was also Barling had Jaegers and open up, and now they're fully operative, and they had a couple new businesses come in as well. So Barling's numbers are up as well. So that their good news gives us good news on the county side. I did point this out to you last city council meeting. This is the local distributions for the industries. I do want to show that first that these are the categories within the actual sectors. The sectors are denoted by the 44, 45, and the first 2 numbers there. I do want to point out that this is the year-to-date average for 2026 for the 7 months, and you're still looking at July. It was the ones, top 15 categories that I picked out are 72% of our tax collection. So as that goes, we go. The general merchandising store was down from the change from average of 2.7%. But if you'll notice, it was up from June. Matter of fact, electronics mail order call-ins, which is online, that dropped. It's also 11% below. And that usually happens because a lot of people are gone for the summer and they're on their vacations and they don't order as much online. Now, one of the things that did happen, though, was Prime Days? Prime Days are estimated to be a 9.3% increase. That's a national increase average. That will happen to us if we see any pickup. It's going to be in the August distribution because that happened in June. So 2 months later, we're looking to see whether that really came to fruition, and I'll be watching this line. Okay, prepared food sales were up significantly. That was one of the sectors that really spurred my interest. They were up 14.4% from the average, and we were up 35,000 versus 30,000 in actual tax collection for July over June. So regardless of what you may be reading, they're not, prepared food sales is not hurting. And I can tell you for a fact, because I know all the details on that, there was a little bit of a pickup from one entity that opened recently, and now they're more levelized off. But the other ones are starting to rebound back as the newness wore off. So the gaps are closing, and now they're doing very well. Even though there's a negative trend line for the top 15, we had a pickup. So the trend line was actually reduced a little bit in the month of July. This is the all merchant codes from 2024, 25, and 26. There's July's numbers for what we collected. I do want to point out that the 359,960, which is the all merchant codes collections for July, is higher than the year of 24, but not higher than what we got in 25. 25 July was a little bit higher. That's interesting to note. Here are the sectors. I do want you to know that I told you that all the municipalities usually pick out these top 4 to talk about because they're usually the ones that account for more than 75% of their collected tax. Everything else is minor. When you talk about it, manufacturing was down between July of 25 to July of 26 by 27%, 21% increase in wholesale, 2.25% between July's of 25's collections and July of 26's collection in the retail sector. Retail is not faring as well right now in that regard. But food service from 25 to 26 years is up 24, almost 25%. And that,
If you look at this in August, that retail trade, the opening of schools, going back to school, I think that's gonna be a big deal.
it depends on how much comes in on tax exempt day, how much purchases are there. That will have some impact, and that would be October's numbers. So we'll see what happens in October, but if there's usually a little dip there, it has a lot to do with the fact that everybody shops on tax-free day.
But a negative 2% in the retail though is still a pretty big number compared to the other ones because it's such a.
Large amount, $10 million worth of taxable sales there. And that is the actual sales. Food service, 1.7 million, wholesale trade. Now, remember, this 10 million does include online. That's in that number. I will tell you, when you compare 26's and 25's first 7 months by each of these sectors, you're looking at, and all of them are increased in 26 versus 25's 7-month totals. So when you look at the manufacturing, they're up 18.68% this year versus last for same period, 21% up in wholesale, 0.38% up in retail. That did drop, by the way, from June's numbers, as you know. 10.3% up for a comparative 7-month periods, 25 over 26. When you look at all four combined, 26 over 25, just for these 4 sectors, we're up 3.4% in 26. Everything looks positive on those categories.
There you go, you always bring it back and say, that's about what the inflation is running.
Absolutely. It's not they're buying more, they're paying more. It's true. So now what I want to do is get into real quickly just some citywide 5-year comparisons on what I consider to be some of the hot topic items so that you can see where we're trending this year for the first 6 months versus the first 6 months of 22, 23, 24, and 25. This is not a year annual comparison to here. These are the same periods for each of these years and what we did in those previous years. So everybody's hot topic is citywide fuel expense. Our actual citywide fuel expense is down. This is even though you may look at this as a positive trend, you got to look at it backwards because we're going 22, 23, as you see down at the bottom, to current. So this is positive because it's lowering expense, and that's always positive. There was an excellent job of recognizing that there was a need to monitor your fuel because fuel costs were getting to be outrageously high again, as it was back in 24 when that dollar amounts were high there too. And I applaud them for the first 6 months. They're really managing those costs. And for citywide, there may be some pocket departments that have some issues, but citywide, the numbers are very good for 6 months. I say that, and tomorrow, all you know what's going to break loose. Premium gas for everybody.
So how are they managing this? I mean, how's that trend?
I know that police put out a thing about how to idle less, sit more. They're doing some things internally that would use less fuel. And Park's doing the same, yeah.
Well, they're doing a good job.
As far as that is concerned, yes.
The first half of this year, gas fuel prices are going up.
So, I mean, those are the real numbers. Those are actual numbers.
Everybody's doing a good job.
Now, realize that 43, we are up from last year, but the costs are way up at the pump. I would have expected this to be more of this kind of a trajectory than that kind of a trajectory. And now I'm gonna go to show you salaries. This is the salary line from where we are just January through June. And a lot of things were paid out that are normal payouts a little early could influence this. Remember, this has nothing to do with budget right now. These are the actual dollars for the first 6 months of the year, for each of those years. So you see that there is an increase there, but that's expected, and then that is something that you're only paying what's in your budget. What could influence that would be turnover. It takes 3 months to get somebody new, or you don't hire somebody when you needed to. But you see the breakout by the category. You see the elected official costs as they were budgeted. You see the labor cost. You see the, what's not in here then is, this includes, by the way, you guys, all of you. The code enforcement is the stopgap salary that's being paid for the notes and the code enforcement work that's being done until the code enforcement comes. But the code enforcement will still utilize this new salary code. It will be now added into that, and it will fall under the planning department. At least that's where it's destined to fall. This is falling under the general department. And now I go to, come on, turn. Chemical expense. You always hear the chemicals went skyrocketing a couple of years ago, especially after COVID. And there was a shortage. There was some problems with some chlorine factories, and the dollar amounts went way up. But for the first 6 months of this year, due to a lot of things that the Water Sewer Department has told their commission they have been doing, it's been being controlled. They're the largest user of that, by the way. As far as, to some extent now, Parks is using it, because Parks has the splash pad, and so they're incurring chemical costs. But they're buying it differently now. I think Tanya's buying more in bulk, and they're doing it at much lower prices because there's economies of scale when you buy in bulk and buy lots. They're doing it from different suppliers. They've done some changes to where it's obviously benefited them. So for the first 6 months, it's under control, and it's not as previous years. These are some of the key items. Health insurance. This is a nice favorable one to talk about. You'll notice the big drop in what our health insurance costs have been. And this does include even with the fire department added in. They're in these numbers. Just so you know, right here, the reason there's this big drop is AML. Going over to the AML side. Good decision a couple of years ago.
That was 24.
That was 24, was the last year before AML, and then we went to AML in 25. Yeah, say that louder.
You're welcome.
There you go.
Does the,
Let it in to you.
does 25 account for what we added in for the fire department?
Yes,
So even with that, we're still dropping.
yeah. Good news.
That is-
So, and that's an obvious large expense to the city. It's $500,000 a year, so it's why I'm showing you. That's 6 months right there. This is the income statement for what's known as municipal court distribution and jail fees. In the past, well, around 23, that was a huge discussion going on because, there was this thing about the cooperative thing that we had with take them over to this, if they have mental illness to that, and we were gonna pay for, well, that never came to fruition. This is also a very favorable trend. You do see that they are not zeroed out here. Their court distributions for the fines, fees, and everything that comes through the court is much greater than what our jail fees cost are, which means we're not arresting people and taking them to jail. No, he's not even here. But then again, it doesn't mean they're not given tickets, but the jail fees are from the housing costs that we have to bear whenever one of our prisoners go to the jail. Maintenance and repairs, this is a huge item because there's so many different subcategories of maintenance and repairs. And you can look at this because it is in your tablet and you can peruse it. One of the things that I will get to in maintenance and repairs has to do with the senior center building, but I'm gonna break that out a little differently. Primarily I think I might have another slide on that. Primarily because if you look down at not-for-profits, where is that? Nonprofit. Back down here on nonprofits, this was the maintenance and repairs that we were doing for the other building. Utilities is also included in a review, and I'll show you that in a minute. But you'll see that even though it's a negative trend line over the last few periods, it's mostly influenced by this 2024 $361,000, which came from two line items, one being the pumps and one being the plant shop. And instead of repair to pumps, there was a lot of capital spend by Tanya or Dalton beforehand to buy new pumps. Stop trying to repair and put Band-Aids on a dilapidated system, and they've done that.
Pretty bad.
Pardon?
Some of them got burned up one right after another.
One right after another. I'm just telling you what I know. So that's a favorite one. Materials and supplies, while it took a little bit of a downturn, we're back on the up side. Most of that materials and supplies comes just from that one category. Materials and supplies spends, I can departmentalize that a little better because there are certain departments that's more applicable to. The sign is the actual making of street signs. That's what that comes from. And then the materials and supplies from plant, that's for the plant operations, anybody that has a plant category, which is water sewer. They both have plants. But this one would be a cautionary one, a little high on the materials and supplies expense for the first 6 months. I don't know what they plan. Maybe they spent some and it's gonna ride out for the rest. I don't know. We'll have to see what happens in the next quarter. As far as the retirement benefits for Lofty, that's also another very heavy, this is a $600,000 deal here this is a 6-month number. You think about it it's over $500,000 in the retirement benefits. But you look at the benefits paid right here at the top so far, that's for the 7.5% for what we have for the non-uniformed personnel. Retirement benefits for fire, this is your retirements for the retired council and city attorneys, not council, city clerk and attorney. And then this is the LOP fee, which it includes the LOP fee side. So right now, there's a little bit of a downturn to it for 6 months, which is good, on the good side, considering that we will probably end up a little bit less, even though the cost went up. As far as utilities is concerned, this is an interesting one, primarily because if you look at the bottom number here for streetlights is, if any citizen says, I need a streetlight, or I want a streetlight on this road, or there needs to be one here, it's not free. The city pays for that. The taxpayers pay for that through this expense right here. This is half a year. I told you last year, or I think the last meeting, that last year's expense is right at $100,000. We're now looking at it being about $110,000 just on the streetlights.
And this is in the neighborhoods, on the poles.
Anywhere there's a street.
This is the billing from Swedco and Arkansas Valley.
Mhm.
Do they charge the same rate?
It's not a metered charge. A streetlight costs X amount per month.
Okay.
And we get to confirm that they've gone to LED.
They
They are working on it.
that's not gonna change that rate. Because
That-
we don't pay, it's not metered.
Okay.
So
Right, doesn't matter, but they are for their benefit.
it helps them, yeah.
If they're charging us whether that street light's burning or not, right? I mean, they
Yes.
It would be until somebody notifies us, yeah. we should.
It's- if
a
it's-
mayor, And typically, street, he's not here, he works from the street department, but those guys, that's their job to, do they go out every night to do it? No, but, the police, I think, also assist in that, taking note, to,
So if a streetlight's not burning, and that's to our detriment, because we're paying for it to burn during the night,
typically, we get, sorry, Tom, we
Okay.
get a call from the citizens.
right,
We usually don't have to check.
right.
They tell us.
But if it's burning during the day,
But the street department does go out.
Right, right. Now,
if it's burning during the day, we don't pay more for it burning during the day. But they still would like to know if it's burning during the day, because it hurts them, the electric company.
Do those figures take into account what so we also have some that are independent that have a meter, like over coming down Denver Street.
You mean the,
There's a meter that, and we're supplying powering those.
you're supplying power for them?
we're,
The decorative ones or the
Yeah, like the
decorative
decorative
ones?
ones.
Decorative?
yeah, that's a different, that's,
That's not,
So that is not wrapped up in that. That is purely the unmetered ones.
right.
Okay.
we get a separate bill from SWEPCO and AVEC for the lights that SWEPCO and AVEC provide, and it's a flat rate. They're not ours.
Do we know how much they're charging us for each one? Like what one?
Yeah, we do. I just don't know what it was. What did he say? Yeah,
I don't remember.
it's like
We had
$25
a
a,
meeting with them a while back.
Yeah.
Talking about all this.
because we thought they were metered. And he showed us, no, they're not.
It's just a fee,
Yeah.
but we don't know what that one fee is.
We do. I'd have to go look at it. It's on the bill.
Yeah,
I just don't, there's so many numbers in my head right now. That's not one
I
of them.
understand, I understand.
But, yeah, I'll do better next time. I'll try to know everything.
Mark that down,
Demerit. Okay. Let's go to advertising and promotion. Those are the ones that I wanted to share. Oh, let me go back first. Utilities for the nonprofit. You see the senior center utilities. This is the actual one that's out on 71, first year of full operations, partial in these. What I wanted you to see here was, this is the utilities for the senior center that we had over, that we're releasing. So when you look at 3,000, there's an 8,000 roughly savings between last year and this year, just in the first 6 months, because the utilities are far less where we are now than what we were paying at where we were.
You're welcome. Sorry.
And we're getting rent now, rental for the building. We're now charging for them to use it for outside of the scope of the senior center's hours, for, a birthday party or whatever they want to use it for. And they pay a fee for that. So it's a good thing. Although I do want to point out another thing on this, I forgot, I just remembered, because I see this very negative trend line. Look at the dollar amount for just the overall utilities. And we're at $205,000. That includes solar. Yeah, would you go flip the switch? Turn them on. We had a discussion with both, with SWEPCO, because we didn't think we were getting our rebates or our monies that we should be getting as credits. And we had an interesting discussion on that. And we talked about the fact that not this year, but next year, we're going to be looking at making that decision as to whether we buy the plant or not. And you're going to be needing to make that decision based on the contract that we have this year in about October or November. We need to keep that in the forefront, because that is a potential $1.2 million decision if we want to invest in owning that solar plant versus continuing to lease it for the next 22, 23, 24 years. I think it is 24 years. I think it's a 30-year lease we have with them. So we need to keep focusing on that, because the AVEC grid, if you will, power plant, is large enough that you could see some savings on it. Not to the extent that University of Arkansas sees when they build a humongous plant, because the larger the plant, the more kilowatt hours it generates, the greater your ability to retain and achieve a reduction in your overall utility cost. SWEPCO's not big enough. SWEPCO literally told us, you will never recover your cost on this.
I wonder if we were to purchase that and take those solar panels that we're using for SWEPCO, make our RVEC solar rate bigger. We would save more money there and we just go back to paying SWEPCO.
I'm not sure how that works as to how they calculated what that size needed to be based on the buildings that they're servicing and the kilowatt usage that we have. That's a discussion you'd have to have with them, with Scenic Hills. That's an excellent question. There was some other questions about, well, in the SWEPCO side, where would you get a bigger return? And that would be you supplement, you don't do net metering with SWEPCO. You actually put the panels on top of your buildings or power your building with a small array per building, like what First National did.
Chief loves that.
Yeah, I know, I'm ignoring him. But that came right from the SWEPCO guy, because we did talk to him about that. So there's a lot of options, but that SWEPCO bridge is not until next year, at the end of next year. But this year, I guarantee you, Scenic Hills is waiting to come back and say, okay, what's your decision? And I don't want to be behind the eight ball. Okay. Advertising and promotion I want to talk about. This is a report that the Advertising and Promotion Commission gets every time they meet. It shows their historical about what we've done over the last, since 2018. It also shows 2026, the current year. What we are now starting to show is the penalty revenue that we're generating from the penalties, and we are on them, and they are going to pay that penalty. If you don't pay on time, you will have a penalty, and you will pay it, and it will compound until you pay. The discount, though, a lot of people are taking advantage of that. It's 2% of the tax that they can reclaim for themselves and put it back into their business, and that's by the state law. And your ordinance says we follow the state law. So they don't have to take the discount, but they can, and we have several of them that are doing that. But this is a way to show how much it is. It's on our books. I knew somebody's going to say, well, how much are we getting in the penalty? Well, so we're accounting for it separately. It amounts that right now the early pay discount is equating to about 1.1%. So in dollars, it's $229 just for that month. You're looking at it right now cumulative being $465. Yes, that's $465. If they didn't pay us, we could distribute in grants. 40% of that would go to the Parks Department, and the other 60% would be allocatable to some requested grant at grant time.
It's incentivizing to pay on time.
It is incentive. It's a cash flow thing for us, because if you delay 2 and 3 months, which I will show you on a slide, but just to further this one, down at the bottom it's the cumulative, and right now cumulative we're over last year. We started ramping up. We're 11.12% through July. That's as of today, what we've collected on that. So the average monthly collections now has gone over the amount of average collections for last year. So one of the things that I was showing you is the pay, no, don't pay, pay, no, don't pay, pay. This little hiccup thing that was going on drove me crazy. Oh, where's the catch up? Catch up, catch up, catch up, catch up. And now there's a penalty to do that. But there's an incentive not to do it. And hopefully we're going to see more of this type of thing, where the lines are more evenly, to not ramp it up and down.
Hiring another employee helped that a lot.
Yes, it did. It sure
I
did.
didn't have an assistant to help me out.
Yeah.
So it's a good thing.
And it's something that we enjoy actually tracking down. Hound dogging. Sick 'em, yeah, I know. But anyway, here's the total Julys. What I do is I also give them each July for the years 2018, just so they can see how this July compared to the previous Julys. And you can see the trend is very positive. So, 2026, it's showing pretty robust growth still. Average monthly collections is still up. As a matter of fact, it's the second highest in the 8-year period that I have statistics previous to this year rather.
And it's getting close to doubling since 2018.
Yes.
Pretty good.
Right. So one of the things that I wanted to also point out, that was A&P side. And we're getting to the end, guys. What is it, 10 yet? 10 o'clock?
Oh, you're right.
You're over your 5 minutes.
You can leave. Yes, you can. Mayor said you can. General insurance renewal. We received, and I've had meetings with Teresa, and we received the amounts. What you see up here, this was the 2025 actuals versus the 2025 budget. And you see the change from the actual to budget for last year. But we did a lot of changes. Most of it came from the deductible buyback. We couldn't support this year after year. From the 2025 budget, when the actual came around and we saw the renewal was a little higher than that, we made some dramatic changes, and we made some decisions as to what not to cover with hail and wind damage. That's all it buys back is the hail and wind coverage portion. So we limited it to the buildings that were necessary to cover. We took off the lift stations, and all of them were covered in this 91,000. Lift stations, pump stations, they're all not part of that buyback. For what it would cost to put a new one up there, and the 3% or 5%, now it's down to 3% of the cost as a deductible, it wasn't worth putting it into this policy. So we made these decisions, we presented it to you, you guys looked at it. Now, we budgeted a 5% increase, I noticed. See that little space right there? It's supposed to be an A. But anyway, so this 5% is what is currently in the budget. Now, what I received, equipment is lumped into property. I will get it broken out, but this dollar amount of 241,000, while it looks bigger than the 5% budget, it's including that 28,000 in this. So the all in all, the amount for the renewal is 6.54% down from the property and equipment side, 2% up on the vehicles, newer and full coverage and more. As far as the deductible buyback, it came in 5.9% below the budget amount that we have. All in all, we're from previous year, we're 1.6% up from the actual last year, but we're 3.2% down from our budget.
That's very good.
It is good. Now, we haven't accepted this, and we still can talk. I haven't even approached the mayor on this. There's some things that we still have that we could do to make that even better if we want to accept a little more risk. So that's some of the things we have to, this is basically not changing any of the risk factors that are currently built into our policies.
Good. If we have our contingency plan being fully funded, do we accept it's a little bit more risk?
It's not a bad consideration. We'll talk about this. This is hot off the press. I got this week. So that's a good point. We could see how far we could get that down and still be adequately covered. So that's it. That's all I wanted to chat with you about.
Where'd you get that picture from? That's a good picture.
Casey took it.
Good job, Dave. That's a good picture.
It doesn't have to be holiday.
I don't know. It came from it's on our F drive as a picture. Obviously, it's a drone. You can tell that we're doing the Main Street extension right here.
Yeah.
I just thought it was a beautiful picture. I mean,
It's a good picture.
look how pretty the downtown looks. The rooftops look. By the way, if you look right here, that's the solar array on top of First National Bank, right there. Look,
Yeah.
that's the solar panels.
All right, gentlemen.
I think it's good until, you know, you have to redo your roof and whatever, but now it's gonna work.
Got to take them things off. If it were me, back here, if this were their property, I would have put the solar arrays somewhere off of it, not on the building.
Yeah.
But they didn't ask me.
Well, it looked kinda funny right there next to the old cabin.
Do they need a parking lot this big?
They're old in the new. Good report. Thanks to the historical society. And we're looking in good shape.
So far, for the first 6 months. Well, I'm not saying go out and spend shoot the moon for the rest of the 6 months. Keep doing what you're doing to keep it that controlled.
I don't know if Chief, if you are in here, but, Tom, your fuel maintenance program's working out, you know, even though we had pretty extensive fuel increases this first half of the year, y'all were doing a really pretty good job. Appreciate that.
What do you call it? Idle?
With a mild restriction.
Oh, I thought you had a cute little name for it.
And then no idling,
Right, okay.
no unnecessary idling.
Yeah. They're doing a good job. I mean, I know the rates flicker up and come back down. They're coming down in Fort Smith. They're still high here, but they're back down to 345 at the Walmart neighborhood market, and they're 355 in downtown. Here, they're still 372. Now, I'm not saying go to Fort Smith to buy your gas. We need that gas tax back. Let me give you an update on that. Okay, the gas tax, the federal part of the gas tax, we've had our audit, our city sales and use tax audit that we commissioned. And the gentlemen are coming back to finish, but they got all the information. We were able to provide a report from our gas cards, because our gas cards are retail cards, just like you would buy gas, and the federal tax is paid on that. So here's some good news that we're hoping for additional revenue on. That 17.3 or 14, it's either 14 or 17, I don't know what it is, but the portion that's federal tax, we knew that police and fire, well, diesel's a different animal, but police and fire, they're exempt from that, from the federal tax. So is every department in the municipality. We are able to reclaim the gas tax. Now, initially, we were told we can only go back for a quarter. So they are going after the quarter, but then from that point on, every month after that, we're filing the reports to get our federal tax back. So that'll help.
All those years we had fuelmen, they said nobody but police.
These guys showed me the law, and they're going after all of it. So I said, you get it, and I'm going after it.
When was that law passed, so can we go all the way back to that?
Well, the law has been it used to be a year, but recently they changed it to a quarter. It's for the preceding quarter up. You got, for the first quarter, you had to file for the first quarters in the second quarter. So they're going after April through June, and they have until the third quarter ends to get that filed. And that's how it works. So, that's what we're gonna do.
Need to share Stewart's fuel man card, pass it around the city as they're filling up.
He has a fuel man card?
No, not.
Is it not fuel man?
No,
Not
thank
anymore,
goodness.
right?
No.
Well, whatever the new one is, you just need to go grab it from Stewart's truck.
No, it doesn't need to. Every,
All the departments.
we're all, that's what we were told. I'll believe it. I was always under the impression it was only public safety vehicles.
Yeah, that's what we were told over and over.
Right.
We even researched it and somebody confirmed it, so we just kept going.
And I mentioned that to the auditors, and they go, no.
Wow.
Yes, because this is not rebatable. This is actually federal money coming back to us that we never got in the first place. We paid them. So this will go right to each department. We have it broke out by department, so the money we get back will go back to each department. We'll distribute it back to them, and we'll continue to do that.
Well,
So-
good job, staying so dogged on that.
And they get how much?
30%. But remember, that's only on the initial. They agreed with our request that they share that process with us so that we will do it from now on.
Mhm.
Yeah.
Good job.
Yeah, that's great.
Well, good.
So I end on a high note.
I wish we could do that for the franchise.
Yes, that would be awesome. But they don't do, we asked them, they don't do franchise audits, franchise tax audits.
All right, thank you, sir.
Mhm.
Thanks, Tom. Any questions, council, comments? Chief, did you want to say real quick something about the fuel? I mean, they bragged on you, so it might be a good way to end.
No, I just, well, we.
Okay.
He is extremely prudent and very ahead of the curve in making sure that he heads off any potential overages in his budget. He is line item focused.
Was showed in the graph.
Yes.
On his fuel.
But his line item focus is, he wants to make sure that regardless of how he's managing his budget overall, that those line items stay in. But if it's not, he wants to come and justify it and explain it to you, and I commend him for that. But, this meeting, I wanted to show you, there's really, right now, nothing to worry about. He's managing it very well.
Keep on keeping on.
Yeah.
Motion to adjourn.
Okay.
Second. We'll have to- Thank you, Tom.
You learn more than you ever wanted to know.
Good job, good job.
Welcome.
You just practicing with this.
You in the flag. I'm trying. I'm trying.
Thank you, Dan.
I got salad this week. Cause I ate it too. Thank you. I don't eat
That is.
Okay.